Welcome to the Poundcast, the Digital Pound Foundation's podcast, dedicated to explaining and discussing all aspects of a digital pound and the impact of new forms of digital money. Your host today is Jannah Patchay, Policy Lead and one of the originating members of the Digital Pound Foundation. Today, Jannah speaks to Nick Philpott of Zodia Markets. In this episode, Jannah and Nick discuss his experiences with the Libra project and how the stablecoin landscape has developed from a policy and regulatory perspective, as well as examining the top wholesale use cases for stablecoins.
I'm very happy today to be joined by Nick Philpott. Nick is the COO and co-founder of Zodia Markets. Nick, would you like to introduce yourself and tell us a bit about what Zodia Markets does?
Yeah, sure. So Nick Philpott, CEO and co-founder of Zodia Markets. In my background, I was at Standard Chartered for about 15 years. I started in the graduate program back in 2006 after I left the British Army. I did my rotations around various different departments in the bank, so a spell in West Africa, which was really good fun. And then followed that with various different roles in the financial markets part of Standard Chartered. And that culminated in a role as the head of market structure, which was in the electronic trading division. A quick bit on Zodia Markets. So we are one of the world's first bank-backed crypto brokerages and exchanges. So we're majority owned by Standard Chartered, looking to serve wholesale counterparties in spot crypto. We have a sister company as well called Zodia Custody, so not to be confused with them. Our minority shareholder is a company called OSL. We have quite a big pedigree out in Asia and the Far East. And really what we've done is we've tried to take their experience of dealing in crypto assets for the last sort of 10 years or so and combine that with the diligence, the rigor, the knowledge of risk management, the network that Standard Chartered has to create Zodia Markets.
Great. And one of the reasons I was so excited to have you on this podcast, Nick, was because you were involved in the early days of Libra, weren't you?
I was, yeah. So that started back in 2019. We met the team from Facebook and from Libra. And really what they were trying to do was very compelling. The way that I thought of it was trying to undo what Mark Andreessen refers to as the original sin of the internet. So back in the early 1990s, 93, 94, Netscape had partnered with one of the big credit card companies, and Microsoft had partnered with the other one. And they very quickly realized that it was going to be impossible to put payments into the browser. So to get that seamless user experience that we still don't really have today, if you're on an e-commerce website and you want to buy something, you click on it, then you get stopped in your tracks, you get taken to another screen, which is run by your bank or your card provider, you do your security bits and pieces, and then you get to go back and actually buy the thing you wanted to buy in the first place. And the reason that exists is because the payment systems are not internet-based. They are government-run retail real-time gross settlement systems. Yeah, there's a bit of an advent of faster payment systems, but fundamentally it's still not based on internet rails. So you have to have payment gateways and various other intermediaries that take you from the internet to the other. So really what Facebook was looking to do with Libra was to create an internet native digital currency. So very similar to Coin, Ethereum and things like that, albeit Libra was going to be centrally managed. But that could be integrated with Facebook, so Facebook Marketplace, for example, with WhatsApp. So you should be able to send money. You should be able to send funds as easily as you can send a text message via WhatsApp, and then also Instagram. So potentially you could start using Instagram as an e-commerce site. It's a very compelling idea, and it undoes that original sin of the internet that I mentioned earlier, which the outcome of that failure to put payments into the browser was that the entire economic model of the internet is based on advertising. And over the course of the last sort of 20, 30 years, that's ultimately resulted in breaches of the public trust through data privacy leaks, data privacy scandals, and so on and so forth, because a lot of the internet is focusing on the user and the individual, and that obviously leads to a lot of problems. Instead, if you can actually put commerce properly onto the internet, i.e. put payments on there, then you can sidestep that and you can create an alternative economic model for the internet that really will transform it and transform economies globally.
So I guess there's something else I've taken away from what you've just said is that we aren't able to fully realize the power of the internet at the moment because we don't have internet native, digital native currency. And similarly, as we move into a more digital economy, as we start adopting more of the metaverse, for example, we're not going to be able to fully realize all the potential benefits or implement all the possible use cases unless we have that internet native money.
Yeah, I mean, so today we do, I think, just to change slightly what you said. So Bitcoin and Ethereum are internet native money. Stablecoins, private sector stablecoin like USDC, for example, very much internet money, or certainly have the potential to be internet money. So it's an adoption question. I think, to your point, what we don't have today is a traditional government fiat currency, so Federal Reserve money, Bank of England money, and then as an extension of that, commercial bank money. So you don't have M1 and M2. Neither of those are internet native. And so that's the problem you get, where you have all this intermediation that sits between whatever it is that you want to do on the internet, whether it's send a remittance to a loved one in a foreign country, whether it's you want to buy something online, including cross-border, or if you're doing something in the metaverse, for example, you're playing video games or doing whatever it is you want to do.
So back to Libra, I remember back in, was it 2019?
That was when we started working with them.
Absolutely fascinated by the concept. And once I'd read the white paper and unpicked it a little, I actually did a whole very geeky regulatory dissection of all the different stages and all the different actors and potentially regulated activities being undertaken in the kind of Libra life cycle and ecosystem. And I think everyone remembers Libra and knows that it ultimately failed. Yeah. But what actually happened there? Because it had a great deal of potential, obviously. And certainly towards the end, it looks like it was going to be quite viable as a single currency stablecoin. But what happened along the way?
It was a play with two acts. So the first act was the single multi-currency coin. So that was our original concept. So this was, and this is in the first white paper. So that was a single currency that was backed by a basket of other fiat currencies. And the idea was that there would be a weighting. So US dollar would be the largest one. If I remember from the white paper, I think sterling, euro, Japanese yen, and Sing dollar were the rest. I could be wrong on the last one. And that was fine. So that looks a little bit like an SDR, and that makes eminent sense. So for the use cases of putting money on the internet, that made good sense to us. Now, when that got quite a lot of pushback from regulators, they pivoted to a different design, which was multiple single currency stablecoins. And this was where, from the point of view of the existing financial markets, it gets very interesting. Because remember that Libra was designed in such a way that it would have very high throughput. It would be effectively a walled garden. So it's a permissioned blockchain in terms of the validators and those who are permitted to hold Libra. And also it had both wholesale and retail applications. A lot of central bank digital currencies and other things tend to pick one or the other when they want to go for wholesale or retail. Now, the pivot to the multiple single currency stablecoins was very interesting because what it means is that you've got multiple stablecoins on the same settlement rails. Now, today, for example, if you and I want to trade, I don't know, dollar yen, okay, then the dollar leg will settle via FedWire. So that's the US real-time gross settlement system. And the yen leg will settle via BOJnet, which is the Japanese equivalent. Now, those two payment systems are only open during business hours in the respective countries. They're not open at weekends. They're not open on bank holidays. And obviously, the bank holidays don't necessarily match. So you've got a lot of days where there's disjointed overlap or no overlap at all. Now, there are ways you can try to alleviate this. In traditional foreign exchange, for example, you have CLS Bank, which effectively runs a model whereby you can do payment versus payment, which means that if you and I do a dollar yen trade, say you deliver dollars to me, you're just hoping against hope that I will deliver the Japanese yen against you. It's running something called Hostat risk. Hostat was a bank quite a few years ago that went under. And at the time it went under, a lot of those FX trades that they've been doing had only settled one leg. So they wound up owing quite a lot of money to a lot of their trading counterparties. So to alleviate that Hostat risk, you use a bank such as CLS, which effectively just strings together or ties together the two different settlement systems. Now, the problem you have with US dollar and yen is they're only open at the same time for about 3 or 4 hours a day. So the challenge of trying to eradicate this risk, because yen and US dollars are on two different settlement systems, you can only do that on a business day, a common business day, of course. You can only do that 3 or 4 hours in a particular day. So it's quite complicated and it's an absolute nuisance. So instead, if you can get to a situation where the US dollar and the yen are on the same payment rails, i.e. the Libra blockchain, then actually implementing a payment versus payment settlement becomes much, much easier. And if you can do that with multiple currencies, so I think the Libra team in the second white paper were contemplating several single currency stablecoins. I think 5 were listed out in the second white paper. Then theoretically, you can trade those 5 stablecoins against one another as a proxy for dollar Sing, dollar yen, euro dollar, and cable. And to think of the amount of risk that you could remove from the system is quite fantastic. From a technology point of view, I think Facebook is fairly famous for having a huge amount of technological capability and technological awareness. So there's probably quite a lot of trust in them as a provider of that technology. And indeed, the intellectual property was subsequently bought up, I believe, by Silvergate Bank in the end. In terms of what happened right at the end, the denouement, the end of the show, I think your knowledge is as good as mine. I read in the press that it was Janet Yellen ultimately that put the bullet into it. And certainly from my point of view, it was quite tragic. It set the industry and our ambitions to try to remove a lot of that settlement risk from the system back quite some years. But I look at some of the things that, for example, Circle and Coinbase are doing with USDC, about how they're designing that. I think that's actually very exciting. And so I certainly haven't given up on the project of trying to achieve some of the things that Facebook and Libra were setting out to achieve.
And Libra started off in a very different place from where it ended. And as we discussed before this recording, it definitely had a lot more potential towards the end, unfortunately, before it ultimately failed.
Yeah.
But how did it make that journey from where it began to what it transitioned into, the single currency stablecoins? Because that was a very different starting point. I mean, you could almost argue that they were 2 completely different designs, which
they were, or albeit they sat on the same settlement rail. So it was much more a design around the reserve. So the idea is very simple. So if you're a potential user, you want to use a US dollar Libra, for example, you would then go to an entity called a designated dealer, which traditionally would be a large bank. And the designated dealers were the only entities that could interface with the Libra issuer, basically, which was the Libra Association, which originally was based out in Switzerland. And I think after some regulatory input, it decided to relocate to the United States. So the banks are effectively acting as market makers and providing that access to Libra. Now, there were question marks around its treatment as e-money, and I think that was alleviated by the point that a holder of a Libra doesn't necessarily have a direct claim on the Libra reserve. The Libra reserve itself was going to be custodied by a tier 1 bank and then invested in short-dated government securities, with the cash component minimized as much as possible. And I think one of our ambitions was to eventually get access to, say, the Fed reverse repo facility, for example, so you can park the cash component at the Fed. The reason why you do that is if you have a stablecoin that's backed by deposits at a bank, so let's say, for example, you just stuck it all on deposit at JP Morgan, what you have then is a stablecoin. It's basically JP Morgan coin, because those deposits are fractionally reserved and you're running JP Morgan risk. Okay. And it's much better to avoid that. So instead, a better design, which was what Libra was contemplating, was to put it into a money market fund, invest all of that in short-dated US treasuries. There's no FX risk. So it's US dollars to US dollar government debt. And then the cash component you try to minimize or eradicate by parking that cash in the money market fund. But then actually has knock-on features, which are quite interesting for us, that you could potentially treat Libra US dollars as a high quality liquid asset. So that was the fundamental design. You then have CASPs, or crypto asset service providers, that would sit in the network, and they'd be vetted by Libra itself, and they'd be able to either provide custody services or exchange services or things like that. So very much the sort of crypto ecosystem that we see today. And they would indeed probably offer to allow you to buy and sell Libra with Bitcoin or various other things, or do remittances and so on and so forth. Now, in terms of the other actors, the Libra Association itself was a governance organization, and they had, I think it was 25 members, if I remember rightly. And it was a mix of venture capital, NGOs, financial services. I think there was a couple of card companies in there at one time. Again, what I understood from the press was that some pressure had been brought to bear on some of those members. And if you remember, there was a point when suddenly quite a lot of them left. So there's sort of a sequence of Libra taking quite a few knocks. I think in the end, it was down to the reputational risk. I think Facebook had obviously had the big data privacy scandals. I think it was just at the point where it was just going to be too hard for them to continue to do it under the Facebook banner. Perhaps if it was done by Apple or Google or Amazon, maybe it would have fared better. In terms of failure, that's probably one thing where very friendlily I'll probably take issue with. I actually think it had quite a few benefits. So, for example, I don't think a lot of the central bank digital currencies or the exploration of central bank digital currencies that we have today would have happened at all if Facebook hadn't taken this plunge. I certainly don't think we'd have things like the BIS Innovation Hub and this sudden urgency around the need to innovate around government payment systems. Granted, some governments were doing it anyway, Sweden with the krona, Nigeria with the e-naira, and China with the e-yuan. But I think a lot of other countries wouldn't have felt that sense of competition and that need to start to innovate and try to improve things and explore these technologies and the potential applications of them. So I think there's still net, there's been a good benefit. And also, it's probably also helped inform a lot of the regulators, because the team that Libra had at the end, they've managed to pull together a lot of very talented individuals who are doing a lot of consultation and a lot of lobbying and a lot of education as well of legislators and regulators. And so, for example, if you look at the European Union's markets and crypto assets regulation, I think a lot of the sections that govern stablecoins, I think were actually very much designed in response to what Libra was doing. I think there's a lot of value in having prompted that level of thought, analysis, and reflection by the European regulators. And I think in the longer term, that's going to be very much a net benefit for the market and for the economy.
Yeah, it is quite interesting, that legacy of Libra, because you're quite spot on with the CBDC angle, that a lot of central banks were perhaps inspired is too positive a word, but were highly motivated by the potential for something with as massive reserves as Libra to start acting their monetary sovereignty and things like that, and access to users as well. I think that Libra also inspired a lot of additional work in the stablecoin space, as you say, as on the regulatory side. And indeed, it's probably one of the reasons why most of the stablecoin regulation proposals that we have actually address this concept of a globally systemically important stablecoin, even though we don't have one.
Yes.
Libra was probably the only thing that was ever capable of being, straight out of the gates, that kind of globally systemically important stablecoin, wasn't it?
Oh, absolutely. It's something like 2.3 billion potential users once you aggregate up Facebook, WhatsApp, and Instagram. And actually, just to be fair to the team at Meta, they haven't given up. So again, I think it's a matter of public record that they've since partnered with Paxos, Novi, which is the sort of the client-facing arm, financial services arm of Meta.
Wallet.
Yeah, the wallet provider, correct. It was one of the first CASPs. So they're still going. And I believe they partnered up with Paxos, which is, amongst other things, the stablecoin operator. So they have USDP. So a lot of the rails and a lot of the structure and the governance is still there. And Novi had quite a wide array of licenses in an absolute multitude of jurisdictions. I mean, again, you could probably Google these, but it was places like Guatemala, the Philippines, and so on and so forth. Countries where there's a huge reliance on remittances. So the Philippines, for example, I think it's 25% of the Philippines economy is based on remittances. So one of the really quite poignant use cases, which has a particular resonance with me, because I started my career with Standard Chartered in Nigeria, was that if you, for example, are remitting money from the United States to, the Philippines, then on average, this is World Bank research, if you remit $200, your average charge will be about 7%, so $14. If the recipient at the other end is earning $1 a day, maybe $1.50 a day, then you're looking at 1 or 2 weeks worth of work has just gone up in smoke just from a very simple remittance. If you then extrapolate that out to being sort of 25% of the Filipino economy as an example, then you can be putting fairly substantial percentages onto the economies of some of these countries. And so the potential for improved wealth generation, health improvements, financial inclusion, and so on and so forth are quite profound. So whatever opinion people may have of Meta and Facebook and so on and so forth, there is nothing about that isn't laudable. And to be able to do that at very low cost and extreme speed as well. So if you're able to remit money as easily as you send an email, and again, that's to the point of emails are on the internet, payments are not. So if you can move money like you move email, then I think that's absolutely fantastic, albeit, of course, in a compliant and regulated and in a way so as not to enable money laundering and terrorist financing and so on.
Absolutely. And so we've talked about the broader global legacy of Libra, but it's had a legacy for your work as well, or what you're doing in Zodia Markets. So can you tell us a bit about about what your stablecoin work is about at the moment, and how you're carrying that over into explorations, use cases and benefits for wholesale markets?
Yeah, absolutely. So Zodia Markets, as I said, it's a wholesale brokerage. So we'll deal with any kind of institution, ranging from a family office all the way up to and including a central bank, everything in between. So corporations, private wealth banks, asset managers, hedge funds, and so on and so forth. We then also have the exchange. So it's like an EBS market, but for crypto versus crypto and crypto versus fiat. One of the biggest problems we have in our business, certainly from the operational side, is anything that involves fiat. So crypto trades very much like any other asset. So someone phones you up, you get a quote, you like the quote, we execute a trade. Someone places an order onto our exchange, someone else places an order, you get matched, great, you got a trade. So all looks fairly normal. The deviations from traditional finance or traditional financial markets are that settlement is almost always T0. Settlement takes place 24/7, so it's internet-based, and there's no bank holidays, and fiat simply is not. So if you're doing a fiat versus Bitcoin leg, the Bitcoin leg can settle on a Saturday, and the fiat leg, you may have to wait until Monday. I mean, this is pretty damning if you consider that, what's today? It's a Thursday. So if I went on to Amazon Prime tomorrow morning and I ordered something, I'd probably actually get physical stuff on my doorstep by tomorrow afternoon. However, if I did an FX trade tomorrow, it wouldn't settle until Tuesday. That's moving data across government payment systems, and yet Amazon can deliver physical stuff to my doorstep significantly faster. I mean, that's quite a massive indictment, frankly. So that's the problem. So there are ways of getting around that. Number one is you could use a specialist bank. So examples include Silvergate, Signature Bank, for example, where they've effectively created closed networks of crypto market participants. You deposit US dollars there, and then you can settle tokenized versions of those US dollars outside of payment system hours. You can settle at weekends, bank holidays, 24/7, and it's incredibly quick. Or alternatively, you can use a stablecoin. Now, the real appeal long-term with a stablecoin is interoperability. And this is where sort of people keep quite rightfully asking after the debacle with FTX and Voyager, Three Arrows Capital, and I could probably name quite a few other names after that, is what's crypto for? And certainly from a traditional financial services perspective, it's that interoperability. Okay, so if, for example, I could have Ethereum, or if I wanted just to stay in traditional finance, maybe a tokenized version of US Treasury, but hosted on the Ethereum blockchain. So let's use both examples. If I can then buy and sell that with USDC that's also on the same Ethereum blockchain, then I've got two different assets that are on the same settlement rails. Okay. Whereas traditionally, if I wanted to buy a US Treasury with dollars, I've got the dollars on the FedWire system, and I've got the US Treasuries are at DTCC, the clearinghouse for US Treasuries. Now, if you've got tokenized dollar and a tokenized US Treasury on the same settlement rails, then the potential for doing payment versus payment settlement and for doing instant settlement, or at least T0 settlement, and doing that 24/7 are going to be much, much easier. So, for example, instead of settling to someone's address, I could settle to a smart contract address that enables PVP, so payment versus payment settlement. So, for example, if you and I do an Ethereum versus USDC trade, both on the Ethereum blockchain, I post my USDC to the smart contract. The smart contract tells you that I've delivered. You then deliver Ethereum to the smart contract. Smart contract executes. I get my Ethereum. You get the USDC. If you fail to post your leg, after a certain period of time, the smart contract returns my assets back to me, my USDC. So what that means is I've gone from a situation where I've got that Hashtat risk, which I mentioned earlier, that counterparty risk, to a situation where I've got hopefully far less risk in terms of replacement cost risk. So if you fail to deliver, I'm still short of the Ethereum that I wanted in the first place. So I've got to go and trade that with someone else. But that's fine. That's not as bad as I'm left with a situation where you've got my USDC and I've got nothing. Plus also a small operational risk that will that smart contract actually do what I'm hoping that it will actually do. So it's that interoperability. If you can bring a whole series of different assets, so foreign exchange, they become stable coins, bonds and equities, they become tokenized. Gold bars, for example, you can tokenize those, and then you can overlay derivatives and instantiate those as smart contracts. You can have this whole multi-asset ecosystem sitting on the same settlement rails. So as a result, the amount of risk in the system, whether that's Hashtat risk, whether that's all the RWA that you have parked against settlement risk, and so on and so forth, if you can minimize that, plus also all the funding that you have around payments, because all of these payments are going to be happening so much more quickly, then that's going to massively de-risk the operational side of the financial markets, if that makes sense.
It does indeed. I think it raises a lot of interesting questions as well, because at the moment, we've got the system that has loads of latencies in it, inefficiencies, as you've identified. And in some cases, those are a bad thing, because if I have settlement risk, or if I have the counterparty exposure over a prolonged period, I have to accommodate that on my balance sheet and my prudential obligations. That impacts how much I've got to play around if I'm a bank. But this model changes everything quite fundamentally. If I've got instantaneous settlement, then that does reduce my risk. But on the other hand, over the decades, as a bank or as one participant in the financial system as a whole, I've developed loads of business models that are based on these inefficiencies and on these latents. Short selling, for example, how does that work in an environment in which you've got T+0 instantaneous settlement? Other business models that are based on inefficiencies, how does it impact the liquidity and funding management within a bank and things like that?
Well, I'd say things like shorting, for example, are still very feasible. So one of the things that we do in our model is, so we're very much segregated in terms of our activities. So we have a sister company, Zodia Custody, that I mentioned before. We actually use other custodians because we believe in an open architecture model. So, for example, our minority shareholder has a custodian as well, OSL Digital Securities, and we use them too. But the model very much is that we try to minimize the movement of assets as much as possible, because it's expensive. You have to pay on-chain settlement fees, and it's risky. The more transactions you do on-chain, the more signing with private keys that you're doing, the more risk, frankly, you're creating. So it's much more efficient to place a charge on those assets while they're in stasis or in custody, and you're effectively cooperating with the customer, who are a customer of both you and the custodian. You're cooperating with the custodian as well in order to lock the assets and basically place that charge. So then you can move them around. At the moment, that's purely for settlement reasons. So what we do is you place a charge over the assets, you represent those assets on the trading platform, on the exchange or on the brokerage. You allow the customer to trade, which is done off-chain. So this is the big thing that I think a lot of people don't really understand, that a huge amount of, in fact, the vast majority of crypto asset trading is taking place off-chain. Okay, and then what's actually sent to the chain is net settlement. So if you've encumbered the asset at the custodian, you can then trade it, but then the follow-on use cases are to use it as collateral. So you lock it, and then it's simply a series of API calls and messages that are going to whatever recipient it is. Yes, your collateral is here. You've arranged through terms and conditions to place a legal charge over it, or whatever other legal control you might want. It could be pledge. And then also it's very conceivable that you could use it for borrowing and lending, i.e. borrowing in if you want to go short. So someone else, say, for example, say a long only holder, a MicroStrategy, for example, who's just going to hold Bitcoin forever and a day, might be interested in lending those out for short sellers because it's a way of generating a degree of yield. But ideally, they want to keep those Bitcoin safe in their custodians, in their custody, wherever that custodian is. So this sort of model would enable for those Bitcoin to still play their part in the financial markets and in the trading of these assets. And then once you withdraw or want to actually settle on chain, that's the point at which you actually do your net settlement on chain. So it's a way of not throwing the netting baby out with the T0 bathwater, if that makes sense.
Yes, it does. My next question would be, obviously, where you do settle instantly, that's great when you need it. But if you are just doing all this intraday creation of the charges and net settlement, then aren't you just replicating the existing financial model? Where does the innovation come in this? Where does the potential for innovation come in this new market structure?
Yeah, so a lot of the innovation, it's actually two things. Number one is just enabling financial market infrastructure to cope with intraday settlement and intraday trading. So quite a lot of systems these days are batch systems. So for example, Zodia Markets, we don't use any legacy systems from any bank. All of our technology comes from our minority shareholder, OSL. And all of that has been designed within the last 5 or 10 years, very much with digital assets and a T0 environment in mind. So the general ledger, that updates in real time. Market risk, that updates in real time as well. The whole thing is designed for this T0 environment. So that's the first thing. So that's a degree of innovation.
But not everyone's is, which means that in this transitionary period between the status quo and the
Yeah.
digital financial markets of the future, you have to be able to accommodate the latency. Is that what we're getting to?
Yeah, pretty much. And this is sort of modernization that a lot of people probably imagine that the financial services industry already has in place, but it really isn't. A lot of it is very much batch based. It's all quite clunky. So it's probably not innovation so much because it's not particularly innovative, but it's just a case of updating everything to
It's a stepping stone.
It's a stepping stone, exactly. So anyway, so that's still a net good. The true innovation, I think, comes in enabling that interoperability. So, and I think that's actually where custodians, which already do a lot more than they already do like in traditional finance. So yes, they are a custodian in the sense that they're maintaining a record of what you own. Number two is which is a bit more of a departure, is they're keeping what you own, which, if you take the case of a Bitcoin, is just a 256-bit random number. They're keeping that incredibly secure for you and then insuring it and doing the signing and so on and so forth. In terms of the signing, they're almost acting in some senses as a payment services provider because they're enabling you to interface with the blockchains and enabling you to effect settlement. But I think in the medium to long term, the potential for innovation there is going to be quite profound. So, for example, it makes sense to me personally for custodians to host smart contracts. Okay, so they can be a disinterested third party. And the simplest smart contracts at the start could just be, like payment versus payment smart contracts, effectively allowing custodians to act as settlement agents. So if you and I are trading, we're almost subcontracting the settlement to a trusted third party. And the trusted third party is effectively enabling you to use the trusted mechanics, I should say, of blockchains, okay, which is fundamentally based on the universal language of mankind, which as an Englishman, I would wish is English, but is actually maths. So that's what you're placing your trust in, cryptography and mathematics. So I think that's where a lot of that innovation can come in. Beyond that, it's going to be the ability to move assets at speed with the same level of ease as we have with email, for example. Longer term, I think as the digital asset rails themselves become much more efficient and the throughput becomes efficient, I think that's when you're going to start to see more of a transition to on-chain to trading, taking on-chain, which in my view is effectively what DeFi, if I oversimplify it a bit, but is what DeFi is doing. So it's using on-chain rails to allow for execution and order management. And if you look at one of the Solana projects that's being run by a lot of the market makers in crypto, the Pith network, so that's trying to take market data and place that on-chain. I think that's the first step to taking execution and placing that much more commonly on-chain as well. Because market data, if you go back to 10 or 20 years, market data is just what your eyes and your ears are consuming when you're standing in the middle of a trading floor, I don't know, in CBOT or Life or whatever it is. It's listening out for the trades and the quotes and the orders that everyone else is placing. And it's also your eyes. So if you see that two big dealers in the market are having a quiet whisper to one another, then you know something's afoot and something's in the market. So that's really what market data is, in my view, and putting that onto a distributed ledger so it sits in the same place as your settlement and as your executed trades, then I think that suddenly becomes very compelling and very interesting indeed. Where that will lead from an innovation point of view, I actually don't know. It creates the environment where I think a lot of innovation can take place, put it that way.
Thanks, Nick. And a lot of what you're doing at the moment is, I think, quite interesting because you're actually managing to do a fair bit within the confines of the existing regulatory perimeter.
Yeah.
As I understand it, what changes to the regulatory perimeter and to the regulatory framework for, let's not call them stablecoins anymore, new forms of digital money would help you progress your plans?
Yeah, I think at top of the list will just be education and awareness. So we touched on it earlier that one of the biggest benefits of Libra was just getting a lot of people to sit up, particularly in the legislative and the regulatory spheres, to start delving into this and learning about this. So continuing that, I think that's the foundations upon which you then do everything else. In terms of regulatory activity, in my personal view, I look at spot crypto and a lot of it looks very much like commodities did, for example, in the late 1990s, early 2000s, or indeed the foreign exchange market, late 80s and early 1990s. And again, you remember that, in the UK, the pound was until 1981. So your free floating currencies are still a relatively new thing. But I think a lot of it looks like foreign exchange. The foreign exchange market itself, the spot market, I should clarify, that is unregulated. So, for example, there was a recent paper by the European Commission, or ESMA, that was very clear that the market abuse regulation does not apply to FX spot. So yes, FX spot is outside the regulated perimeter, but there is one of the largest, if not the largest market in the world, and it functions pretty well. How does it function pretty well? Well, the regulation actually focuses on the actors in those markets, which tend to be banks, for example. So there's already a pretty strong and sensible corpus of regulation in there. So, for example, CAS makes a huge amount of sense. If applied to an entity like FTX International, then I think perhaps a lot more of FTX International's customers would still have their funds today, or at least those funds would have been properly safeguarded. In FX Spot, we also have the FX Global Code. It's relatively new. I think it's still less than 10 years old, but there's a huge amount in it that I think if we got clarity from the regulators to say, a lot of it looks like FX Spot, go forth and treat it like FX Spot, then a lot of people would very quickly turn to the FX Global Code, for example, and use that. On the stablecoin side, this is probably the area where I do think there is some action needed. And from what I've read, the UK regulators are already turning their attention there. So at the moment, coins sort of fall between several stools. So that's e-money. So I think, for example, USDC, you could treat it as e-money, but then the e-money regulations are very much prudential regulations. So they're focusing on the backing and the reserve management and all of those sorts of things, which is well and good. But then there's nothing on the trading of e-money. So if you were to put e-money onto an exchange, fairly unprecedented, what would you do with it? There are banking rules around, again, how you would manage the reserve. That's obviously if you've got the reserve on deposit at a bank. Instead, if you choose to put it in a money market fund, then we're into money market fund or UCITS rules. So I think there's so many different rules that sort of tangentially relate, but it would be quite nice just to stitch that together somewhere in the middle and just make sure that stablecoins don't fall through the gaps into the white spaces. And then finally, if you've got tokens that are clearly securities, then MiFID II and MiFIR are over there and they can be applied fulsomely and that will work. And similarly, if you're doing a derivative on crypto, again, that will drop fairly neatly into MiFID II and MiFIR. And over in the United States, you'll have Dodd-Frank and you can put it on CEFs and all of those good things. So I think if we got that clarity and just knew, rather than have an excessive fixation on trying to create, we just have to create something new, actually look at the toolkit we have available and see if you can drop things in there. That would create a lot less disruption, a lot less need for education, because people like me who know a little bit about MiFID II could very quickly pick that up, or about CAS or the FX Global Code, could pick that up and very swiftly apply it, knowing that they're not inadvertently doing something wrong, that they're trying to do the right thing and will be backed up by the regulators as such.
As we've learned from FTX, actually trying to do the right thing is an important start in this business.
Oh, my word. Yeah, absolutely. I mean, they seem to have committed accounting fraud, banking fraud, securities fraud, all in one. I think they've got the hat trick.
Basic mismanagement and failures of oversight. Yeah.
Absolutely. I can safely say we do not approve our expenses using emojis at Zodia Markets.
Thank you very much, Nick. It's been fascinating having you on today.
I've enjoyed it. Thank you very much.